So, ICICI Bank's latest results, they dropped a bit of a puzzle on the market. You look at the headline number and you see a surprise dip in profit. But then you look under the hood and the bank's core engine seems to be firing on all cylinders. In this breakdown, we're going to solve that puzzle and figure out what is really going on with the bank's performance and where it's headed. Here's how we're going to tackle this. First, we'll untangle that surprise provision that really warped the profit number. Then, we'll dive into the bank's real core performance. After that, we'll check out the strength of its balance sheet, and we'll wrap up by looking at the leadership and their long-term vision. All right, first things first, we have to isolate the single biggest factor that skewed this quarter's results. It's this large, one-time provision that honestly dominated the entire analyst call. This one number, 1,283 crore rupees, pretty much hijacked the entire quarter's results. It's a one-time, regulator-directed provision that caught the market completely off guard and, single-handedly rewrote the profit growth story. I mean, just look at the sheer impact of this adjustment. The numbers they reported show a 4% profit decline. But, and this is a big but, if you strip out that one provision, the underlying reality is a 4.1% profit growth. That is an 8 percentage point swing, all caused by a single accounting entry. Crazy. So this immediately brings up the most important question for any investor, right? What in the world is this provision for? And more importantly, does this signal some kind of deeper problem with the bank's loan quality? Okay, so it all comes down to something called priority sector lending, or PSL. Basically, as part of its annual review, the Reserve Bank of India took a look and found that some of the bank's agricultural loans didn't quite tick all the boxes for the specific rules for PSL classification. And look, management was crystal clear on this point. This is a classification issue, not a credit issue. The borrowers, they're still paying their loans. The problem isn't the health of the assets themselves. It's about the regulatory paperwork behind them. The context here is key. We're talking about a portfolio that's been built up over more than a decade that now just needs to be brought in line with the regulator's current expectations. But here's the real kicker for investors. Management confirmed that once they meet compliance, this provision can be written back to the profit and loss account. That creates a potential boost to future earnings. Okay, so if we park that one-off provision to the side for a minute, what does the underlying health of the bank actually look like? Let's get into the core business engine. The core lending engine is showing some really strong diversified momentum. While domestic loans grew at a very healthy 11.5%, the real standout, the real showstopper, is the business banking portfolio. It's surged by almost 23%. That points to some serious market share gains in a really critical commercial segment. Now, this isn't just growth for growth's sake. It's not undisciplined. Both sides of the balance sheet are expanding in a really controlled, smart way. You've got solid 9.2% growth in deposits, which provides a stable funding base for the 11.5% loan growth. And that growth is being done in what management keeps calling a risk-calibrated fashion. And that discipline is clearly paying off. In a market with really intense competition for deposits and with interest rates all over the place, the bank held its net interest margin steady at 4.3%. Just maintaining that core profitability in this environment, well, that's a huge operational win. All right, now let's get into the numbers that the big institutional investors really zero in on, the numbers that tell you about the bank's stability and its ability to handle any economic shocks that come its way. First up, asset quality. It just keeps getting better. The net non-performing asset ratio, that's basically bad loans after you've set money aside for them, it declined even further to a very, very healthy 0.37%. And along with those low bad loans, the bank has this massive safety cushion against any potential losses. A provisioning coverage ratio of over 75% means for every 100 rupees of bad loans, they've already set aside more than 75 rupees. That is a very conservative, very strong position to be in. And this one is absolutely crucial. The bank's capital position is exceptionally strong. With a total capital adequacy ratio of 17.34%, it's way, way above the regulatory minimums. Management even said on the call that this capital buffer is very much adequate to fund future growth, which means they won't need to go out and raise more money. Okay, finally, let's shift gears from the hard numbers to something a little softer, but just as important. Let's talk about the bank's forward-looking strategy and a key leadership decision that was a major topic of discussion on the analyst call. So management took the time to walk through its core strategic pillars again. Now, you might look at this and think, okay, corporate speak, but this is genuinely their playbook. It's a disciplined framework that guides every single decision, all with one goal: delivering sustainable, risk-adjusted returns for shareholders. But this brought analysts to a key question about governance and, long-term stability. The question that kept coming up was, why was the CEO, Sandeep Bakshi, given a 2-year extension instead of the more standard 3 years? The bank's official line was really consistent on this. They said the 2-year term was a mutual decision made between the board and the CEO himself. The subtext here is pretty clear. They're trying to downplay any speculation that this was about a lack of confidence from the board. Management also clarified a really important point on the timeline. Since this new extension only kicks in way out in October 2026, it effectively locks in leadership continuity for almost 3 years from now, all the way into 2028. That definitely helps calm any nerves about immediate changes at the top. So, this brings us to the central question. The one thing you need to ask if you're thinking about investing in ICICI Bank today. We've established the balance sheet is basically a fortress, and the core engine is strong. So the entire investment thesis now hinges on this. Was this PSL provision just a one-time cleanup, or is it the first sign of a more challenging regulatory environment to come? That is the key risk to watch going forward.